Private equity fund structure. How money moves from LPs to portfolio companies. Hello and welcome to Candy Mentor. Today we're going to walk slowly and clearly through the internal architecture of a private equity fund. We'll explore how money is raised, how it moves through legal entities, how GPs and LPs interact, and how cash eventually returns after exits. By the end, you'll be able to visualize the entire PE machine from commitment to distribution. What the PE structure represents. A private equity structure is a legally stitched ecosystem built to pool capital from investors, deploy it into companies, improve them, and exit for profit. Everyone inside the structure has defined boundaries: who supplies money, who manages it, and who actually runs the operating companies. The loop is simple: buy, improve, exit, distribute. But the governance around it is precise because billions may move through this structure. Limited partners, LPs. LPs are the investors who supply capital. They include pension funds, sovereign wealth funds, endowments, insurance companies, and high net worth individuals. They commit capital up front, but they do not send money on day one. Instead, they promise, "I will provide 100 crore whenever the GP calls for it." LPs receive detailed reporting and protection through the Limited Partnership Agreement, or LPA. Their risk is capped. They cannot lose more than their commitment. And importantly, LPs do not run the portfolio companies. They are passive, not operational. General Partner, GP. The GP is the professional manager of the fund. This is the team making investment decisions, negotiating deals, supervising portfolio companies, and driving exits. They earn two types of compensation: a management fee that covers operations, and carried interest, the share of profits once returns exceed a hurdle. In legal theory, the GP carries unlimited liability. But in practice, firms use a GP entity, a limited liability vehicle, to shield individuals while preserving legal structure. The fund vehicle. The fund itself is usually a separate legal entity, often an LLP, trust, or limited partnership. This vehicle receives capital commitments from LPs. It then deploys money during the investment period, usually the first 4 to 5 years. Overall fund life is typically 10 to 12 years. The rules, obligations, fees, and governance are documented in the LPA. Think of the fund vehicle as the pool that receives money from LPs and pushes it into deals. Capital commitments and capital calls. LPs commit a fixed amount. The GP calls this money only when needed. This avoids idle cash and aligns timing with deals. When the GP issues a capital call, each LP pays its pro rata share, exactly in proportion to its commitment. Capital calls can be made for new investments, follow-on rounds, management fees, and fund expenses. This system keeps the fund efficient and disciplined. Fund flow, visual logic. Here's the core money path. LPs commit capital, the fund draws capital, the fund invests into a portfolio company, often with leverage. Over time, the portfolio company generates cash, dividends, interest, or exit proceeds. Those flows return to the fund. From there, the fund distributes money back to LPs according to the waterfall structure. And the GP earns carry if thresholds are met. A loop of capital, improvement, and return. End. The Investment Committee, IC. Inside the GP, the Investment Committee is the highest decision-making body. It includes senior partners who approve deals, review valuations, and sign off exits. The IC acts as a guardrail, ensuring discipline, fiduciary duty, and risk oversight. Nothing important moves without IC approval. Portfolio company. This is the operating business the fund invests in. manufacturing, technology, healthcare, consumer, retail. It varies by strategy. The GP may acquire a controlling stake or a minority position depending on the fund's mandate. Through board seats, governance frameworks, and operating playbooks, the GP works to grow EBITDA, strengthen the balance sheet, and prepare the company for exit. How deals are structured. Most deals combine equity from the fund with debt from banks, a structure called the capital stack. Funds often use SPVs, special purpose vehicles, to hold investments separately. SPVs contain liability and simplify co-investing. Deal terms include price, covenants, governance rights, and exit mechanics. Every element is negotiated and documented before money leaves the fund. 1. Management fee economics. The GP charges a management fee, usually around 1.5 to 2% per year. In early years, this is calculated on total commitments. As the fund matures, fees often shift to a percentage of invested capital. This fee pays salaries, travel, compliance, due diligence, and research. It keeps the lights on while the GP works to create value. Carried interest waterfall, carry, is the GP's performance fee. It follows a waterfall, a step-by-step distribution order. Step 1. Return of capital. LPs get back everything they invested. Step 2. Preferred return. LPs receive a hurdle return, often around 8%. Step 3. Catch-up. GP receives accelerated share of profits until its total share reaches 20%. Step 4. Split. All remaining profits are split 80-20 between LPs and GP. This structure aligns incentives. LPs earn first. Then the GP is rewarded for strong performance. SPVs, special purpose vehicles. SPVs hold individual investments. They ring-fence risk, meaning troubles in one deal do not spill into the rest of the fund. They can also create tax efficiency and simplify ownership for co-investing LPs. SPVs are common in buyouts, infrastructure, and large platform deals with multiple subsidiaries. Co-investments. Co-investments allow LPs to invest extra money directly into specific deals alongside the fund. These investments usually come with reduced or no fees. They help grow deal size without diluting the fund's ownership. LPs love co-investments because they lower cost and can boost returns. End. Value creation system. After buying a company, the GP activates the operating playbook. This can include pricing improvements, procurement optimization, digital transformation, new sales processes, and tighter working capital discipline. Governance strengthens through board oversight, MIS, and KPI monitoring. The goal is simple: drive EBITDA growth, expand margins, and improve cash flow. Monitoring and reporting. Funds report to LPs at least quarterly. Reports include valuation updates, NAV calculations, operating metrics, and material events. Annual audits and compliance certificates ensure transparency. ESG reporting, environmental, social, governance metrics, is now standard. All this builds trust and keeps LPs informed. Amen. Exit paths and distribution. Typical exit paths include sales to strategic buyers, sales to other PE funds, IPOs, and dividend recapitalizations. When the fund exits, cash flows to the fund first. After fees and carry allocations, distributions flow to LPs. These distributions often form the basis for DPI, distributed to paid-in capital, a key performance metric. GP-LP alignment mechanisms. Alignment is built into the structure. GPs commit their own capital, skin in the game. Preferred return ensures LPs earn before GP carry kicks in. Key person clauses protect LPs if senior partners leave. and no-fault divorce clauses allow LPs to remove the GP under exceptional circumstances. These mechanisms keep trust and discipline alive. Risk and governance layers. The PE ecosystem has multiple risk layers: financial risk, leverage levels, valuation accuracy, concentration; operational risk, management capability, competition, execution quality; compliance risk, AML, KYC, regulatory filings. The LP Advisory Committee, or LPAC, reviews conflicts and major decisions. Governance acts as a stabilizer through the fund's long life. Fund Lifecycle Summary. A typical fund moves through 5 phases. Fundraising, up to 18 months. Investment period, years 1 to 5. Value creation, years 2 to 8. Exits, years 4 to 10 and beyond. And finally, distributions and closure. It's a slow, disciplined cycle designed for long-term compounding. End. Closing summary. LPs commit the capital. GPs deploy it. Portfolio companies transform and grow. Exits return cash. And governance ensures discipline at every step. This entire machinery exists to turn capital into value through active ownership and operational improvement. Final takeaway. A private equity fund is a structured engine that multiplies capital. LPs supply the fuel. GPs steer the strategy. Portfolio companies generate the transformation. And exits deliver real returns. Once you understand this flow, you understand how private equity really works, from first commitment to final distribution.